a startup and you had early round shares and those are early round options and they were at 50 cents an option, you want to exercise those really early because they're cheap and you could do it while the fair market value spread was really, really low. It's reducing taxes wherever we can, or at least eliminating the surprise for you. I do not work in the surprise business. I am here to make sure if you're going to owe a big check at the end of the year, we at least want you to know it's coming so you can be prepared for it. You're going to be hard pressed to find many individuals in the United States that are going to have a more complex tax return than Donald Trump does. And you probably will not be able to get a lot of insight, good or bad, into what that person's personal wealth is, what their cash flow situation is, any of those things. I'm Will Geeslin with Geeslin Group, and you're listening to the Real Takk Podcast.
What's going on, guys? Well, thank you always for listening. Welcome to another episode of Real Takk. Today, I'm with my good friend, Will Geeslin, CPA, Will Geeslin of the Geeslin Group. Will was our first corporate accountant, actually, at Compass, formerly known as Urban Compass. Will and I connected in the summer of 2014 back at our Union Square office, where then we were only maybe 25, 30 brokers. Leonard Steinberg had just joined, Kyle Blackman had just joined, kind of a very still small operation. And we probably had a few dozen staff members. I think Will was the first official accountant for the company. And we probably had maybe 24 engineers and a couple business people. Prior to joining forces at Urban Compass, Will worked at Ernst & Young for 2 years, honing skills as a number cruncher. Will hails from Atlanta, Georgia, where he was also an ex-resident of the Warren House condominium in Murray Hill, New York City. Will ran the New York City Marathon, and he's also a proud alumni of the Auburn and the Auburn Tigers football program. Go Jason Campbell, who actually was an ex-Washington Redskin or the Washington football team quarterback. Football team of Auburn. You guys are playing Ole Miss this Saturday, and you guys haven't yet played Alabama and LSU in this delayed, weird COVID season. But in any event, Will, thank you for your time and welcome to the show.
Thanks, Takk. I appreciate it. I'm happy to be here. The one thing that you left off in my bio, though, and the thing I'm probably most proud of is I was the inaugural champion of the Urban Compass Fantasy Football League. So, my strongest legacy.
You were, and we were really competitive back then. We had so many players we had so many teams that wanted to play. And yes, you are the champion, and we're the champion, and you will hold that title as long as the Urban Compass / Compass Football League is present, and it has been still. So it's going strong. So we're in our 7th year going strong. What else? Oh yeah, you are also, I believe you're also the championship of the Compass Cornhole tournament, no?
If I remember correctly, we made a strong showing, but I can't claim the championship on that one.
You made a strong showing.
My skills left me.
At the semifinals, it was you and your teammate versus Danielle on my team and Brian Renzenbrink.
Yes.
And she still remembers getting beat by you, and so she has a sour. Right. I was actually talking about you last week. I was like, oh, I'm gonna have Will on the podcast, and I was like, do you remember him? She's like, yes, very much. I remember him when he beat me at cornhole, and that's definitely a sour point of Danielle's career here at Compass.
Okay. Well, I'm glad she's not holding it against me anymore, and she's moved on.
I don't know if she's moved on. She remembers, but yes, perhaps she has moved on. In any event, listen, Will, I definitely appreciate your time. We're doing this podcast with you because a few things. You came into my mind when it's a weird time. Trump had his tax returns released after the 4th year of his presidency, and the media jumped on him, and obviously, understandably, he paid $750, a very ambiguous number for a quote-unquote billionaire. So, having operating a business myself, along with obviously brokers, we're all independent contractors. We have to do our own accounting systems, and we all operate under LLC or S corp or 1099. And I figured it's a good time to jump on, not to talk politics. The full disclosure, I'm not here to discuss, if we're pro-Trump or Biden, and this is not that type of episode, but we're here to discuss kind of the bird's eye view of accounting practices that are common for real estate developers, real estate owners and operators, as well as, what are the common misconceptions that people who earns a salary they may not be aware of what, when the media blasts companies like Amazon or, Facebook or Google, they're not paying quote unquote federal taxes. I think there's so much of that talk of taxes and big companies not paying them, whether it's Trump again or big startups or even, I'm sure Uber, they all have very similar tax implications and obligations and practices and how it relates to them not paying federal income tax. I think it's a great time for someone like you to come on and discuss and clarify, what is actually behind these notions and what the common misconceptions may be. So,
Sure.
Let's first talk about, just the general analysis of Trump's taxes. Why did he only pay $750? And maybe the fact that media outlets can just say on Twitter, he only paid $750. Well, I'm sure as a business owner myself and you auditing companies and individuals for a living, you could probably break that down into more of a analytical look and say, well,
Sure.
actually may not be true.
Sure, absolutely. Well, and the first thing I'll tell you is, like I said, this you can love the guy, you can hate the guy. I am speaking about this purely from a functional standpoint of how taxes work and what you would expect to see here. And the first thing I'll tell you is you're going to be hard pressed to find many individuals in the United States that are going to have a more complex tax return than Donald Trump does. Because he, as an individual, he owns a lot of assets himself, or he has a lot of income that comes from partnerships or single member LLCs that go directly to his tax return. So I mean, his return is thousands and thousands and thousands of pages long. So you have the idea of that gives you a little bit more understanding of how complicated and complex it is. When in reality, what the public is seeing is really just the first page of a tax return. And I could show you the first page of a tax return of someone that has a pretty simple situation, and you probably will not be able to get a lot of insight, good or bad, into what that person's personal wealth is, what their cash flow situation is, any of those things. And then when you add in the factor of real estate developer, anyone in real estate, it gets just a little bit even a little bit more complex, because when I deal with someone that is in as a real estate developer, as a real estate holder and an investor, it is not uncommon to see wild swings in income or in losses, mainly from depreciation, various losses from also just from whether it's depreciation or other adjusting items that are non-cash that you'd expect to see for an individual. And then they may, say they've owned a building for a long time, they've run out of depreciation. All of a sudden, even though it's going to be cash flowing the exact same, they could see a wild swing in income on a tax basis because they've run out of depreciation. You've got a couple of those things. You do have other factors to consider with what the culmination of someone's business holdings are. But then the other thing that people, you see that number, you see Donald Trump's personal tax return, and Donald Trump is a business. He is the sum of all of these businesses. And you have to think about it differently from someone that is owning a privately held business versus what you would see from like an Amazon or a Tesla or any of these publicly traded companies. Publicly traded company, their goal, and when they're out there and they're trying to show a profit, make money, generally speaking, make money and return value to shareholders. When you own a business privately, your number one goal, more than likely, depending on what you want to do long term, is do everything you can to avoid paying taxes in a legal manner.
Right.
People want to say, was there or was there not any sort of illegal activity that occurred? You just can't say, and no one can really attest to that just by looking at the first page of any given tax return.
Right.
But you start having you start getting into these situations where someone who owns a private business, their goal is tax avoidance. So that means, what sort of depreciation can we run off? What other sort of capital assets can we purchase and get these major write-offs under the tax code that are legal, that will then reduce your taxable income? So the $750 didn't that didn't shock me. It didn't surprise me. What people aren't taking into account is an organization, a real estate organization is paying tax in a lot of different ways. They're paying tons of property taxes. They're going to be paying payroll taxes associated with the people that work for them. And then and you do have the trickle down tax effects of all the other people that you're paying. So it's a little more nuanced than just saying, oh, he didn't pay taxes. He didn't pay federal income tax, but there were a lot of other taxes that are associated there. And it is neither good, bad, nor indifferent. It's really just it's more of an issue of these are the rules, and more than likely they were playing by the rules, and they're just leaning into those rules, and that's why he probably paid millions and millions of dollars to have his tax return done by a well-respected CPA firm.
There's always a reasonable explanation on any taxpayer on how they got to their income, but it all depends on the CPA or the CPA firm that person hires to really show how they got to that income. Is that correct?
Absolutely. And I'm sure you see this as a broker dealing with people, especially if you've got a business owner that wants to purchase a piece of real estate and they need it financed too. The underwriting for a business owner is significantly more nuanced in my experience than someone who is just a W-2 employee, because you have to prove that that's really their income. Is their income going to stay the same year over year? Not factoring in that they could have owned this business for 25 years and they put off a ton of cash every single year, because also they might show that return that shows, oh, I had zero taxable income for the year.
Sure.
Let's disregard the fact that they've got $10 million in cash sitting in a bank account.
That's right. As a business owner, one of my biggest nightmares, especially as a real estate broker representing buyers for co-ops where they have to be board approved, is an independent contractor or a business owner buyer who wants to buy this co-op for their family or for themselves, whatever, but they own 6 warehouses with 6 different LLCs. And they each have varying degrees of income, but they also don't necessarily report a personal income. And if they do, it's very, very minuscule, a personal taxable income. So it just seems to be, it's easy for the media, and this is not a pro-Trump or pro-Biden forum by any means, but to any business owner's defense, it is easy for a New York Times to jump on Twitter or any opposing political party to jump on Twitter or Facebook with 280 characters or whatever it may be, and criticize somebody by saying this business owner paid $300, $500, $750 in taxes. It's very subjective of objective, isn't that right?
Absolutely. And it is, like I said, you're not going to say it's either good or bad. And some people will tell you that's great. Some people will tell you it's bad. I'm just saying, these are the rules of the game, and this is the way that people are playing. And if you set the rules up a certain way, and I can't fault someone for leaning into the rules and the ability that they have to make the most of those rules. Everyone is looking for an advantage however they can get it. And as long as it's a legal advantage, more power to you. That's if you're not looking to sell something and show that you've got a huge profit, you would be hard pressed to find many business owners that will tell you, I want to pay the most in taxes I can, because that just means they're leaving money on the table, especially as they want to continue to grow their business, build something for their family, do those things. And this is a conversation I have with clients that have a business that could have $50,000 in revenue, or be a client that does 10, 20, $30 million in revenue. Sure. The challenges are not that different. You just do them at a different scale.
Got it. You said previously when we talked, you said the bulk of developers and landlords, they earn income through a Schedule E. Schedule E, you can explain to them in 30 seconds what that means, but it's basically real estate related income. How do real estate, in 2 to 3 minutes, how do real estate developers make money then?
What you have to think about from a tax perspective is cash flow versus taxable income.
Sure.
And real estate developers, they may not, they will spend, especially in a city like New York, could spend years and years spending money, whether it was their own or through financing, through loans, to develop a property. And so, and they're making zero income on that. So they're just building up exactly nothing. And then all of a sudden that first year, the lights come on, the tenants come in, and they're getting that rent roll every single month. And that's great. But they've got all of those costs that they have capitalized, and we're going to continue to depreciate over the life of that asset, whether it's a residential rental property or it's a commercial space, and it's depreciated over anywhere between 28 years and 40 years. And that will, on paper, drive down their net income on the business from a tax perspective.
Right.
So you guys sit there and say, someone could make $1 million, and these are arbitrary numbers. Someone could make $1 million in rent roll every single year, and they could have, the exact same amount in depreciation. That's $1 million that they didn't spend that year, but they previously spent, or that's the value of the asset. And so from a tax perspective, they could end up with $0 in taxable income. It doesn't mean they're broke or they are losing money. It just means on paper they're showing, they're showing a tax basis income of zero or negative numbers or reduced numbers. So you tend to see that across any sort of rental activity, whether it's a residential, you're renting out a condo as an investor, or you even own an apartment building, or you own a warehouse. So those are, a lot of it is the expense that leads up to it, and then the non-cash expenses that you have over the life of the asset.
Would you say, talking about just how these real estate people earn money, if let's just say they're developing a condo, first-time developer, would you say it's kind of like starting up a startup, like a tech company? Would you say it's similar?
It definitely can be. That's for sure. A startup is just a fancy way of saying entrepreneur. And when we think startup, and you think about companies like an Uber or even a Compass, and how wildly successful the business has been over the life of the business, they're entrepreneurs, just at a order of magnitude larger than what an individual business owner or a real estate developer is doing. Right. So it's like we said, it's the same set of challenges. It's just at a different scale. And so they can continue to have issues and challenges, and you learn on the fly, just like a startup. Sure. A lot of it is trial and error. It's the same thing as, I'm sure those first couple of years you were a broker, you would look back now and you would say, oh man, I knew nothing. I thought I was so wise and so smart. And then you had that first year that you had a good year, and then you got that big tax bill. And like we said previously, that's kind of the defining line, I think, of when someone really becomes an adult. It's not when you're 18. It's not when you graduate from college. It's not when you get married. It's the first year that you have a big tax bill, and all of a sudden you realize, oh wow, this is for real.
Uncle Sam, this is shaking me down.
Yeah. Uncle Sam will always get theirs.
He will always get theirs. So just to wrap up this section of Trump's taxes and how he paid $750, just to summarize it in 1 to 2 minutes for you. In conclusion, you would agree that he probably did not do anything illegal, but he definitely did some finagling of the numbers where he used the system that's created by the federal government to his advantage.
Exactly. And so I could tell you, I can't tell you whether something illegal or legal happened. You just can't tell. But this is a perfect example of people don't recognize the fact that the tax system is, just like most other things, is a political system. And people love the idea of like a flat tax and everyone paying X percent. Yeah. But what tax policy really is, when it comes down to it, is a carrot or a stick that incentivizes people into certain actions. And so, you move 7.5, 8 million people, or whatever New York City's population is now, and people keep pouring in. You need people to build buildings for them to work, to live, to shop, and enjoy themselves. And if you don't have certain tax incentives for them to do those things, chances are a lot of those developers won't do it, because it's going to cost them so much money up front. They're never going to get out of that hole. And you could say that's a good thing or it's a bad thing, but it is motivating action that is allowing people, that is serving a lot of other people. And that's all tax policy is. Sometimes it's good, sometimes it's bad. Sometimes it is vindictive. Like, there's definitely taxes out there that are, there to punish certain people or certain states.
100%.
But yeah, so it is a matter of understanding the rules, and he's got a team around him that help translate the rules of the game and do their best to offset that. And that's how I would interpret it. And then you got other people that will never pay taxes because they could be bad business owners and stuff, but just based off of profession, that's how I would have read any real estate developer's tax return. Wouldn't have surprised me to see that.
Sure. So let's shift a little bit, do a pivot. You previously said tax evasion is bad, tax avoidance is good.
Yes,
we are big politicians these days that go on, again, like a Twitter platform. There's only so many words on Twitter, or so many words can be typed in on a Facebook post or an Instagram post. But they love to blast a company like Amazon or Tesla as they quote unquote they pay no federal income tax. 2 years ago, when Amazon wanted to come to New York City to establish HQ2 and LIC, AOC blasted Amazon on the New York Post and all over media saying, why do we want a company that pays no tax? How do we benefit? And I just felt like, not a dig on her or any politician, but I think just people in general need to understand that if you're on salary, you don't really think about this. People that are on salary, they just get everything deducted, payroll, unemployment, federal, state, city tax, MTA tax. It gets all deducted. They don't really think about it, but they need to understand and have a better start saying more educated statements on taxes of why they don't pay federal income tax and why that's legal. And maybe if media was more educated, then the people themselves understand, okay, they don't pay federal income tax, but they also are beneficial in other ways, or they also pay taxes in other ways. So maybe you could kind of go over that on why, first and foremost, Amazon doesn't pay federal taxes, and why, and how maybe, that could have benefited New York, maybe not benefited New York City, who knows? Maybe touch on that.
Well, you threw a lot at me there, Talk. There's a lot of different pieces that go into it. And, if you can find someone that can boil down tax policy and the way things work in 280 characters, let me know, because I'd love to hire them or I'd love to go work for them.
Yeah.
But it is one of those things that the federal tax system is so large and so complex, and it's so different from structure to structure, whether it's an individual, a business, a nonprofit, all of these different things, or the different types of structures, whether it's a C Corp, it's an S Corp, it's a partnership, all of these different things. It's so nuanced and complex across the board. And if there's one thing that I think we can all agree on, is a lot of the conversation that we have today is lacking in nuance. And so we can't have people don't want to spend the time to think about these things, and they just want to have a quick, that's black and white, that's good, that's bad, they're in, they're out, yes and no, that sort of situation.
Yes.
And so when we start dealing with tax policy, especially when we start dealing around multi-billion and trillion-dollar businesses, you want to cast dispersion on them, and no one is a saint, and there's these big companies that do good things, they do bad things, and to a certain degree, when we talk about why don't they pay federal tax, some of them, like Amazon, on some years may not pay any tax at all. That argument is kind of one of the same things that we talk about with like HQ2 coming to New York City. The federal government could tax more on Amazon or any of these multinational corporations if they wanted to, but it's going to drive businesses out, because there are other countries around the world that have a better, or as a cheaper tax system. And in the same vein, when you have these huge businesses that want to put a facility somewhere around the country, certain states have certain tax systems that are more advantageous to a business. And so if we wanted to get rid of that, this would have to basically be every state would have to say, or every country would have to say, let's all just agree to the same system, or let's stop competing against each other. And that's just not going to happen.
Right.
So, so they are, for good or bad, are using those systems to play a little bit against each other, especially on the state level with like the HQ2 thing. But, they are paying taxes somewhere in some manner a lot of the time. But also what people don't take into effect is these large startups, whether it's an Amazon or even like an Uber now. Think about the millions and millions and billions of dollars they've lost over the life of their startup. You can have, you'll have a loss carry forward that can work for years, which means if you didn't pay tax this year and you lost a bunch of money, the next year that loss can help offset the income that you have in this year. Mm-hmm. So if you lose billions and billions of dollars for several years to get to scale, you could have a deferred tax asset that's going to pay off for years down the road. It's difficult, I think, for people that don't own a business don't do this for a living. And, same reason it's like, I talk to a doctor. Sometimes I just got to trust a doctor and say, you know what you're doing. That's what you're here for. It's a little more complicated than it is. Like some people might say, oh, it shouldn't be complicated. Same way you might say for a doctor, well, it shouldn't be that complicated. Or, specifically with a real estate agent, people sit there and say, oh, this doesn't seem that hard what you do. And then it's like when you had Rory on for the last episode and he was talking about, well, here's the 15 things that you need to do before we even get into the weeds. And I'm like, yeah, I don't want to do that.
Yeah, I don't want to do that. Yeah, exactly. Great re-quote from my previous episode with Rory Geeslin.
Right, exactly. Check out the last episode too. Subscribe above.
Yeah. It's really, basically the moral of the story is it's so hard to digest. Somebody like AOC, people look up to her, right? But when she goes on a Twitter rant of being anti-business and anti the system and anti the man, and she says, we don't want Amazon here because they don't pay corporate taxes. But she probably recognized this, maybe just against her political agenda. Who knows? But I mean, can you tell me if this is true or false? Had Amazon HQ2 did come to New York City, I mean, how many millions and millions of dollars in payroll taxes would the state of New York benefited from?
Oh, the state and the city would have gotten a ton of taxes. You have occupancy tax for the office space that they would build. You have the millions or billions of dollars that they were going to pay in development to good union jobs in the city, right, and to developers that were then going to in turn pay payroll taxes. So there was a lot of money that was going to be had there.
A lot of payroll.
I certainly. Yeah. Wait, say that again.
A lot of payroll tax, basically, whether it's engineers or union jobs or just building management, property management, property operation, all of those payroll taxes, the city and state basically missed out on. Is that correct?
Correct. Yeah. And certainly, I think I can appreciate where someone has a stance like that, and they're not totally wrong. I get it especially from a knee-jerk reaction. But you do have to take a kind of a 30,000 foot level and you really see the board. Mm-hmm. And the question is, what can we do to maximize from a tax policy? And when you do these things is what can you do to get the greatest good for the most amount of people from a government perspective? Sure. And if that means giving away billions of tax dollars in tax breaks and incentives to an organization to bring other things in, your anticipation is it's going to ultimately help provide more revenue somewhere else down the road through other income generating operations within the state. So, and that's where it comes into more of a economic debate. And because there's certainly times that they being the government, not New York or New York City, but anywhere across the country. We certainly have had it here in Atlanta where the incentives were just too strong. They made it too lucrative for them, and they didn't get enough back. Because you see, there was a situation with I believe it was a technology company in Wisconsin that was coming over from Asia, and they promised to bring in thousands of jobs. And then they scaled down the facility they were going to build. And so it went from $1 billion project to $100 million project. And now there's only a couple hundred people employed. So the state clawed back the tax breaks they gave them. They were going to give them millions and millions of dollars of tax breaks.
Sure.
And the company tried to continue to claim those. And the state said, not today. And so they took those back and said, you didn't hold up your end of the deal, which is great. And if that's the way it works, that's great. But it's just a tax policy. It's a carrot and a stick. And how do you motivate people to act? Just the same way that we do it with individuals. It's just when you're an individual and you are a W-2 employee who's got a pretty basic setup, when you have less on the table from options and technicalities, you have less wiggle room and options to think strategically about your finances and your tax situation. Whereas you become a multinational corporation or a federal government, you've got a lot more wiggle room and a lot more options to get creative and do things and think strategically today, 18 months down the road and 10 years down the road. Right. And so they are not, certainly there are bad actors out there. There are bad actors that are individuals too. But you've just got a lot of policy out there that then drives the action of what I would consider to be a large portion of the population doing the right thing. Right. So we just don't want to get into a throwing the baby out with the bathwater kind of situation.
Correct. Yeah. I mean, basically, in short summary, you're saying people get hung up on multinational corporations, they get hung up on conglomerates, they get hung up on big tech, but these organizations don't live and die by the rules that the salaried individual lives on. Right.
Well, but you see politicians, that are speaking to the people and they want to be outraged and shake their fists sky and do all of this stuff. And I don't think, I'm sure they have ulterior motives. That's, okay, so be it. But a lot of that too is, they can appease, a Jeff Bezos and an Amazon, but they live in a district in Queens, and if Jeff Bezos lived there, he gets just as many votes as those people in Queens. So you're more interested in making sure that they're all on your side, supporting your cause. So, there's definitely some political motivation in there as well.
No one definitely changes if Bezos lived in Queens.
Yeah.
That's for sure. All right. Well, listen, I know you're a busy guy, so we want to jump onto the next topic very quickly. So a lot of our listeners are real estate professionals, they're brokers, and the number one thing, no matter what stage we are in a broker's career or a small business owner's career, the challenge has always been record keeping or bookkeeping for I guess we'll call it. You get to the end of the year and I'm running my business and you get that big fat 1099 at the end of the year. You spent, the broker or the small business spent all this money in marketing, transportation, entertainment, meals, memberships, coaching, training, your staff, all these things. Independent contractors, they always get in trouble at the end of the year trying to find their expenses. They try to categorize expenses. They want to try to manage their financials, but they seem to always get hit with a big tax bill. It's no secret that small businesses and brokers do get audited by the IRS quite often. So tell me, what are the biggest challenges as independent contractors or small businesses, people like us? What are the hurdles that we have to go through in order to make sure that we're not paying out money like we're buying, multiple Benzes and Lexuses by the time the tax season comes in?
Right. Well, the first thing is, small mistakes tend to make small problems. Big mistakes tend to make big problems. So I always tell people, whether you're a broker or you're starting a delivery business or whatever the business and operation is try and set the foundation correctly when you're small, because the further you get along, the more difficult it's going to be to change things, to make corrections, and just make sure you're moving in the right direction. Sure. So we have got. I always tell people, like we talked about, the number one thing is keep really good records. But that's like a 1A and then a 1B. I'd say just like when you're a broker and you need to have access to, you need good handymen, you need closing attorneys, you need the lenders, you need a Rolodex of people, you need a team of people that you can call on. When you're a business owner or you're a broker, you also need your own team, and that's going to be a financial advisor, a good CPA and tax advisor, an attorney. And so these are people that can help you along the way. And the best thing you can do is, one, keep really good records, and two, educate yourself and ask a lot of questions along the way, because tax planning can be like healthcare. And in the sense of, when it comes to healthcare, you can either be proactive and try and stop a problem from occurring, or you can be reactive and only deal with something after you've already gotten sick or there is an issue. So, if you came to me in, January 15th of next year to rehash what happened in 2020, the ox is already in the ditch. We can't do a lot for something that's already happened in the past. But if you and I have a conversation in July, checking in on how operations are going, what's the year looking like, we can see what you're doing. We can kind of project out what we think your tax balance might look like. And we can then kind of move those dials to say, do we need to spend more money for things that you actually need, whether it's buying more laptops or bringing on another member to your team that will help keep your taxable income down and help you grow your income over the years. Or we just say, we're not making as much money, we need to dial things back. We can do kind of a good checkup on the business. And then do it again. And then I would say do it again if, about this time every year. Check in with your team and let them know where you're at, and keep game planning, especially with what's coming up on the horizon. If there's, there could be a change in administration, there could be continued evolution of tax laws, which there's always changes in tax laws that keeps me employed. You need to be on top of those things. And then as you continue to grow your business, the things that I would be focused on is, you're going to be worried about growing your team, what sort of corporate structure you're going to be, because once you grow that team, you're going to need payroll. That brings a whole other situation where you're going to have payroll service, you're going to have payroll taxes. And at that point, you need to sit there and say, okay, I've been a single member LLC, or I have just been paid directly to me as an individual. It's all going to my personal, my 1040, my individual tax return. But as you continue to grow and you continue to make more money and be more successful, you cross a line where you can make a jump from being a single member LLC into being an S corp and taxed differently.
Right.
And that point you can start paying less in self-employment taxes, because that's what really gets people is they pay
double.
You don't realize it until what?
You get paid double.
Yeah, exactly. You don't realize when you're on a W-2, you see all those taxes come out and you're trying to figure out who this FICA person is and why are they so mean. But when you start your own business, all of a sudden what you realize is there's two sides of that equation. Yeah. And when you're the business owner, you're paying the employee side and the employer side. So if you can make the jump to an S corp, you can actually reduce a portion of those employer taxes. And so there's a benefit to do those sorts of things. And I think there are a lot of people that they don't have a good team around them, or they are not educated on these things. So they can sit there and end up leaving thousands and thousands of dollars on the table just because they were unaware of tax structures and tax maneuvers that are, completely legal and available to them that could be extremely advantageous. And it's just literally filling out a form. That's all you got to do. Right. And so there's situations like that. And then as you continue to do that, it's just that constant revision to your tax planning and being aware of what your goals are and how you want to get there. And just being open-minded to opportunities that come your way. Because I am, like, what I do for a living is I do a lot of that planning piece, and I'm here to help you reach your goals. And then also a portion of that is mitigating taxes, reducing taxes wherever we can, or at least eliminating the surprise for you. I do not work in the surprise business. I am here to make sure if you're going to owe a big check at the end of the year, we at least want you to know it's coming so you can be prepared for it.
I'll say that again. I'm not in the surprise business. And
exactly. So I don't work in the surprise business because I know you don't like surprises as a client and as a taxpayer. Mm-hmm. So I'm going to do everything I can, and your tax preparer and your tax advisor should be doing everything they can to help you avoid any unnecessary taxes. But then also, I always tell people, paying taxes generally also is a sign that you've been successful. So it is not the worst thing in the world. No one wants to pay more than their fair share, but if you're going to owe a big tax bill at the end of the year, I don't want to have to call you on April 15th and say, hey, you need to write a check for $250,000. No one likes that. No one likes that conversation. I don't care how much money you make. That's not a conversation I enjoy.
Oh yeah.
I don't enjoy that conversation, and you don't enjoy it because you've got to write the check.
That could ruin somebody's month.
Exactly.
Yeah.
So we're here to avoid surprises.
A couple quick questions, like rapid fire questions, as a broker myself, and maybe
Sure.
business owners that are operating under either a single, maybe an LLC, S corp, or just 1099.
Mhm.
If a business earns, for example, 100K, the individual takes home a modest salary of 40K through their, just for themselves. There's 60K surplus, and they write off 50K, whether it's marketing and all that, then they pay taxes on that last remaining 10K. Is that cost to get audited immediately by the government?
Like every good tax question, the answer is it depends.
Yeah.
You can't. There's no bright line on what anything looks like. Anyone there's certain professions I would imagine that also just get a little bit more of a quick trigger, because there are certain people that will tend to be a little more egregious in their expenses.
For example, give me an example. Funny money. Break it down.
Okay. Yeah. I mean, I've had someone that tried to tell me they own they own a trucking company, and they bought a $75,000 boat for their lake house, and they bought it, and they said they tried to run it through as a vehicle. And
it is a vehicle.
Right? if you saw $75,000 by itself on an asset sheet for a vehicle for a trucking company, that doesn't look that weird until you look at the name of it, and it's like the Bassmaster 3500 or something. And so you got to make the call, and you have to tell them, this is a very poor decision. You do not want to do this.
Yeah.
And there are always, some people have good reasons, and they may be valid reasons. Then you've got other people that just try and throw everything at it. But it's kind of one of those things. It doesn't take a tax professional to look at some of these things and say, that doesn't smell right. So it's you'll know it when you see it. But I mean, I've seen stuff like that. I've seen, you'd see someone might try and run through a bachelor party as a business expense, and say it was client development and all this other stuff. Someone may be evasive about what it is, and then you just have to tell them, if you get audited, you have to be able to provide the support for these things, and you're the one that is signing the tax return. Like, you're telling me that it's correct and it's accurate to your knowledge, and it still comes back to you as an individual. So don't get greedy. So I mean, I could throw a bunch of country phrases at you, but I don't know if they would land with our audience. So you can get greedy. They always said, hogs get fat and pigs get fat and hogs get slaughtered. And so you can be you can be smart and spend your money where you need to, but don't get too greedy, because it'll get you in the end.
Pigs get fat and hogs get slaughtered. Don't be too greedy.
There you go. You can recognize that from Northern Virginia, I'm sure.
Very good. I like that. It's a very, you are a very quotable man, just like Rob Repton. Maybe that's why you guys get along so well.
Yeah, I always like that about Robert.
Very, very big quote guy. Now, just one more question, I guess, rapid fire. If somebody, business owner, broker, makes 100 grand and they just write off 90 grand on business, whether it's meals, basically they're writing off their entire money. In summary, to you, the question is, that's a grounds for probably getting audited pretty quickly.
Like I said, it depends. It's going to be, if someone, it's not unreasonable for someone, especially if they're growing a business. You've seen it especially with being a broker. You got to spend money to make money. And especially if you're in those early years and you're just trying to grow, you're more concerned about pumping money back into your business and doing things that are going to help generate value for you and for your clients, not necessarily today, but down the road. You're planting seed so you can harvest later.
Right. Okay.
And so if I see someone, especially in a brokerage or is just a business owner, those first couple of years, if they make no money, they lose a little bit of money, I'm not terribly concerned. I hope over the course of a couple of years, we're going to see that income grow, and there's a true, there's a true profit motive there, because sometimes you will see people that want to run a Schedule C on their personal return, and it's going to lose money every single year. And if you do that for 5-10 years, the IRS is going to say, hey, this is odd looking, and they may come after you. But 1 year losing money, 2 years of like that number ticking up a little bit is not the end of the world. And I'm not sitting there saying I'd be sweating bullets staying up at night that the IRS is doing it. But also what I'll tell you is, if you sincerely believe what you're doing is useful and is right, you shouldn't lose any sleep over it anyway.
Of course, that makes sense. I must say, my first year, I made maybe $8,000 in real estate, maybe less, maybe $6,000 or $7,000 just in real estate. I had a second job, but when April 15th came around, I probably had $500 in my bank account, and my tax bill was $4,000. I was losing sleep. I was losing a lot of sleep. Let's just put it that way.
Yeah.
Not stress to our listeners. If you are an individual broker or a broker with an LLC or S corp, I cannot stress the importance of having a great CPA on your team, whether you pay them as a retainer on a monthly basis, or you just let them help you out with your taxes, or you meet with them quarterly. I cannot stress the importance of having a professional tax advisor on your side representing your interests, because my goodness, we are not salaried employees, and our taxes can get very complicated. Once I started to pay out staff, and myself, it has become, the taxes have become completely 100% harder for any individual to understand.
Exactly. Well, you're not an individual anymore. You're a business. And just like we've said throughout this entire podcast is, once you're a business, life gets a lot more complicated.
Life gets significantly more complicated. The last section that I want to talk with you, and I think this is probably one of the more anticipated sections for our listeners, is equity. In a privately held company, let's just say in a tech startup, for example, a company like Compass, a lot of employees and brokers, when they get recruited, they receive shares of the company. They receive equity, whether it's in the form of RSUs or something else, maybe a founder's equity, whatever it may be. Kind of break it down for us. How do you look at that equity, and how, from a tax standpoint, how does that all work? Whether it's RSUs and strike price, and the strike price is very low, very high, the current valuation, the future valuation. Tell me how that works from a tax standpoint.
So it depends on what sort of equity you've got. So you could be granted options, or you could be granted restricted stock units. There's a couple different types of options. You've got incentive stock options, which are only for people that are employees of a business. Then you have non-qualified stock options, which are NSOs, which that's going to be someone that could be an employee, and it's going to be anyone or it could be anyone that is not a direct employee of the business, like a 1099 contractor that happens to work for a business.
Sure.
And so those are taxed at two different ways. And we'll talk about RSUs. They're easier, and we'll deal with that at the end. But an incentive stock option, you're going to, let's say you're going to have your strike price. Let's say it's $5, and the fair market value of the share, whether it's publicly traded or not, is $9. You've got that $4 gain there that's built in. And if you have an incentive stock option, there is typically not going to be a taxable event from traditional income tax on that $4 spread and that value, that $4, I'd call it phantom income that you have. You may pick up some alternative minimum tax, and that is a whole other ballgame. That's what I do a lot with. I deal a lot with people in the equity world, in the stock option world, to help them forecast these things and figure out what the damage is going to be. But that's a whole other conversation that we could spend an hour on. Okay. You could potentially have some tax issues there if you have incentive stock options and you've got enough of them. It's a lot easier. It's a lot less damaging now than it was before the new tax law in 2018. But then your other type, which is probably more relevant for a lot of people listening to this podcast, could be the NSOs and the non-qualified stock options.
Okay. So
back with that same example of a strike price of $5 and a fair market value of $9, you're going to pay that $5 for that. You're going to exercise that option for $5. It's going to give you one share that is worth $9. That $4 spread, that value is actually considered, instead of considered phantom income, it is ordinary income. So that is going to go straight to the front page of your tax return.
Sure.
So there's not a lot of maneuvering on that one. It's just ordinary income. And if you were a employee of a company and you exercised NSOs like that, chances are they're going to just tack it right onto your W-2. They will do some extra withholdings. They make your life a little bit easier.
Sure.
But if you have if you are independent of a company and you exercise those shares and you're not careful, you could be in for a world of hurt at the end of the year. So it's really important when you have when you start thinking about your equity, having a conversation with a professional who does this, one, to educate you, but two, let's get strategic with it. Because I had a conversation with someone this morning that has equity in a publicly traded company, and they've got all of these options out there. And here we are in Q4 of the end of the year, and they're getting to the last bit of their equity to exercise. So we looked at the numbers, and because of the timing and where they are, it makes most sense for them to go ahead and say, let's exercise a little bit this year, and then let's wait till January of next year. Let's just push it in next year, and we won't create a taxable event for this year or for next year. But if they had just gone out on their own and exercised it today, they were looking at a $20,000-$25,000 tax bill on top of the purchase of the shares the options that they had at their disposal. So you've got those two different pieces, and it does get more complicated than that, but from a very high level, that's generally how it works. And then another form of alternative compensation that a lot of employees will get are restricted stock units, and those are shares that you earn based off of your time of service with a company.
Mm-hmm.
And those are basically going to be, after a year, you get 100 shares, and they're going to grant you those, and they're given to you, and it's going to be treated as income. Whatever the value of those shares are, it's going to go onto your W-2, and you're going to have withholdings, and you'll have all these items that are baked in there, and they'll be coded on. Then your tax professional will be able to see those things. But relatively speaking, that's a whole lot easier, because typically also, say you were owed 100 shares, mm-hmm. and the taxes were equivalent to 12 of those, they're just going to give you 92 shares, and they'll net off the taxes, and that value will be added to your withheld from your W-2, and life is neat and easy and clean, and we move on. And then hopefully you just sit there and watch. But you've got your exercise component now, and then you've got your strategy of, once let's say the company's already public or is purchased, then you have to decide, when do you want to sell those shares? Because you got to think about short-term capital gains or long-term capital gains. And that could be a timing issue for one, being over the year, but then also deciding, do I want to sell some this year and some next year, because I want to try and stay under a certain effective tax rate to try and save yourself a little bit more money. It's just, you start playing, you move from checkers to chess at that point. And that's where you need to kind of have a really good game plan, because it can be a great thing, but it can also,
be a risk,
punch you in the face if you're not careful.
Talk about strike price. A lot of these startups always talk about strike price, and I want to go into, I know this is a whole nother topic too, but talk about how your tax implications are affected based on how high or low your strike price is. Second part of the question is, when, let's just say, brokers at Compass have equity, some of them may have equity, and some of them may want to exercise some now. Some of them don't want to exercise at all. Some of them want to exercise after, if the company goes IPO. What are the risks of doing an exercise before going public while the company is still in private? And what are the pros and cons of doing that after it's public?
Sure. Well, the biggest thing is, especially when you're talking about investing in a startup, and if you're exercising your options, you become an investor. And investing is, I'm sure there's someone in the financial world that's going to really hate me for saying this, but investing is really a fancy word of saying gambling. It's just a little bit more informed, or hopefully it's more informed.
Yeah.
And so you get down there, and you have a lot of factors that go into it. Ultimately, I think it depends on the quantity of options you're holding, the type of option that you're holding, and how far do we think we are away from how far away are we from a liquidity event, whether it's being public or being acquired. But the biggest single driver on a lot of the decision is what's the spread between that strike price, or the price that you pay for that option, for the right to buy that share, and what that share is actually worth.
Right.
And so
give me an example.
The big thing. So, the thinking about that $5 strike price and a $9 value, fair market value,
sure.
You've got, from the incentive stock option perspective, your real risk is, you've got some alternative minimum tax that you may end up paying. You've got the actual money that you're going to spend to exercise those shares and buy them. And so you have invested in this capital asset, and let's just play it out to the worst case scenario of that value goes to zero.
Sure.
And so you've got, if you have not paid any other taxes on an incentive stock option, you've got you've lost $5, and you're going to get a $5 capital loss on your tax return, which I wouldn't call it a benefit necessarily, but you do get to offset it against any capital gain you have. So it'll at least help you in that regard.
Okay.
But then if you have a non-qualified stock option and you have bought that share at you exercised at $5, it was worth $9 when you exercised, and you picked up $4 of ordinary income that went to your 1040, and then the next year the stock goes to zero.
Oh yeah.
That $4 you paid in tax, or the tax you paid associated with that $4 of income, that's gone. You're never going to see that again.
Risk. You paid all of that in taxes for $0 in value.
Exactly. So you're out your $5, and then you're out the tax. You get at least the deduction for the capital loss associated with that. But the biggest risk is how far away are we from a liquidity event, and how wide a spread is it between your fair market value and the strike price. Mm-hmm. So if you're staring down the barrel of an IPO, and let's say you were a late stage employee, and your strike price is not that far off from fair market value,
yeah,
your risk is a little bit lower outside of the tangible cost of having to buy those shares. But also at that point, if I had a client coming to me in that situation and they're late stage and it's going to cost them a lot, I would argue, let's go ahead and wait and exercise after the IPO, and let's see what the stock does. Yeah. Because it could pop me, and that may, there's a risk it could cost you more money down the road, but there's also potential that the IPO is a dud, and all of a sudden you realize, man, I'm really glad I didn't buy those shares. So I would say any of that additional cost you've got is think of that more as almost like insurance. We played it a little more conservative. It cost us a little bit of money, but we also knew what we were buying at that point.
Right. Whether you're an employee or 1099, whether you have a non-qualified stock or not, I guess the summary is it is a huge risk to exercise early and then pay those tax implications, whether huge or not, you're still paying them. And then when the company goes IPO and the shares go flat, or if it goes flat, you've essentially paid taxes for nothing.
Exactly. And so it is a question of, is the juice worth the squeeze? Like, are you going to put in, like gambling, are you comfortable if the money you're going to spend, are you comfortable losing it, or could you survive without it? Right. That should be a big factor in your decision making. And if someone's sitting there and the strike price is really, really low, okay, I get it. And especially if you exercised very early on before the price went up, because if you were to come a startup and you had early round shares and those are early round options and they were at 50 cents an option, you want to exercise those really early because they're cheap, and you could do it while the fair market value spread was really, really low.
Right. It's like
exactly. So it's like all of a sudden, if that could cost you, let's say $5,000, and then you did it 5 years later, it could have cost you $50,000.
Sure.
And you'd be much more comfortable losing $5,000. Granted, you could have been a 25-year-old at a startup and you didn't have 2 pennies to rub together, so 5,000 felt a whole lot more.
It's your rent money. Yeah, that's for sure.
But exactly. So it's it is a lot. It's a myriad of factors, and I spend a ton of time with people helping them understand that, and then kind of painting a picture of what their financial situation is, because everyone's situation is different, and everyone's got a different risk appetite or the ability to absorb that risk. Mm-hmm. So that's what's most important is understanding where you are and what you're willing to take, and then also being honest about your prospects on the company.
Correct. Yeah, that's right. That's right.
So
Once you go IPO, how confident are you that the company's valuations that were valued by private investors,
sure.
is that going to sustain in the open market? I mean, you've seen flops. You've seen companies like Snapchat that had extraordinary offers to be
Right.
bought from certain other large tech companies that went
Right.
private, that went public, and they kind of maybe not exceeded their expectations or met.
Right. Right. The question is, are you an employee at pets.com or are you an employee at Amazon? As you know, how do you feel about it?
That's right. That's right. Yeah, it's a huge gamble. So the listeners that are on this podcast that are loyal followers that have equity or that have stock options for a company that may not necessarily be public right now, I would highly encourage you guys to listen to guys like Will, speak to guys like Will, to make sure that you're not really pulling the trigger and exercising on something, not knowing what your tax implications mean for that year or for your future, or even not knowing what that means once the company goes public. Because last thing you want to do is spend a bunch of money of your own money that you could have used for something else or invested in something else, whatever it may be, only to find out that your tax bill is 5x or 10x more than what you thought you were at the end of the year because you spent that little bit of amount of money to exercise your equity.
Exactly. We like I said, we want to avoid surprises. If you want to be surprised, go watch a scary movie.
It is October, it's Spooktober. That is right. There's tons of scary movie options right there. Listen, I thank you so much. Just a couple, and to end this episode, as a former New Yorker, what do you miss about New York City most?
Oh man. Well, when I moved back to Atlanta, there's certain things I loved here. There's certain things I definitely miss. I love being able to walk everywhere. You take that for granted. Really good mass transportation. And obviously, I think these things are a little bit on pause right now, just because of the climate and the environment. But I miss that.
I ride the subway.
So it's like I do miss. I miss that. Something simple. It's probably saved me a lot of money. Is being able to get sushi delivered to your house any time of night, any day of the week. I tried to call a restaurant a while back. It was probably one of the first couple of months back in Atlanta. And I asked them, I couldn't find a place that was open after 9 o'clock on a Sunday night. And I think I ended up eating a bowl of cereal standing over my sink like a real monster.
Okay.
So yeah, I miss those. And it's so much fun. New York's there's no place like New York. It's anyone that ever gets a chance to live there should 100% do it for at least a period of time. And the people that you will meet from all walks of life, it'll open your eyes to, just different ways of life, different people, things that you're never going to get in a lot of other places in the country. And so I think that's good. I think just to give you a really, really good perspective, and the food.
Oh yes, and the food. Jerry Seinfeld wrote a great rebuttal on the LinkedIn post that went viral. I'm not sure if you heard of it, but it's New York City is dead. And there was a great rebuttal that Jerry Seinfeld wrote. Do you think New York City is dead?
There's New York City is a constantly evolving living organism. I don't think it will ever die. Will it look different? Absolutely. But to say this, Rome is still Rome, and New York will still be New York. I just think it may modify a little bit, but if there's one thing I wouldn't bet against, it's New York and the people that live there.
Yeah, that's right. That's right. What's going on with you ran the New York City Marathon. Obviously, the marathon is it was supposed to be next weekend.
Right.
It's canceled. What's going on with your running? Is there a marathon in Georgia that you're going to be doing, or are you?
No, I am. I say I'm semi-retired from marathons. I took a little time off. I got into triathlons. My twin brother and I were supposed to do a half Ironman in Virginia back in May. Then it got pushed to June. Then it got canceled. They pushed it to another race in North Carolina. So I am, tackling half Ironmans and thinking about some longer races. But if I ever run a marathon again, it's going to be in New York City. That's for sure. Georgia's a great place to train. It's a horrible place to run long term, though. There's way too many hills.
there's
heat,
a lot of
humidity,
hills.
and hills, not a good combination.
Yeah, no, I bet. All right. Well, listen, I know you're a busy guy, so I'm going to let you go. This has been a great podcast, a long podcast. For our listeners, please follow Will's company, the Geeslin Group. His website is geeslingroup.com, Geeslin group.com. I will plug your website on the podcast notes, in the respective notes.
Great.
And, do you have any other social media outlets that you want people to know about or follow you on?
I mean, I'm on all the social media. I try my best, but if you want to see a lot of great pictures of my French Bulldog Walter, you can follow me on Instagram.
There you go. Go ahead and plug your Instagram for the users.
But yeah, Instagram. I don't even know what it is. It's I think it's if you just there aren't a lot of Geeslins out there. If you search Will Geeslin, you'll find me.
His Instagram.
Find me on all the active channels. I'm not on the TikTok though. I don't know what the TikTok is.
It's okay. Don't worry about the TikTok. Yeah, you may follow Will on Instagram at W Geeslin, at WGEESLIN. There you have it, folks. Thank you, Will, for coming on, and I hope to see you in New York City soon. One day after all this pandemic is over, we'll get back together.
Absolutely.
All right.
Always good to talk to you,
Talk.
Talk.
Appreciate
Have a good
it.
one. Bye.
All right. Bye-bye.